you're watching The Money Show. I'm with you, Kavita Thapliyal. And money decisions affect every part of our life, from how we spend and save to how we invest and plan for our future. And on this show, where we simplify personal finance and help you make smarter financial choices, that's what we do. But today is a very special and a very important topic that we are discussing. Can debt make you rich? That's right. India is borrowing more than ever before. But here's the real question. Is this debt helping us build wealth or pushing us deeper into financial stress? Now, according to RBI data, household debt has now risen to over 41% of GDP. At the same time, household savings have fallen to nearly 18% of GDP. Now, what this tells us is simple. India is slowly shifting from a savings-first economy to a credit-driven one. Now, the big question over here, not all debt is bad, that's right. In fact, used correctly, debt can actually help create wealth. The problem is not all borrowing is equal. There are two kinds of debts that we are talking about. One, productive debt, which helps you build assets or increase income, and the other, destructive debt. That's right, which simplify funds, lifestyle, and consumption. But how does debt create wealth? Let's understand this. How debt can actually work in your favor. A home loan applies, it actually gives you or allows you to buy a large asset with limited capital and benefit from rising property prices. Business loans, for example, help entrepreneurs grow faster than their own savings would allow. Even education loans, when used wisely, can increase your earning potential significantly. Add to that tax benefits, and the impact of inflation and debt in the right hands becomes a powerful financial tool. So what's the warning over here? The risk that lies in between. RBI has flagged a sharp rise in unsecured loans, credit cards, and personal loans. These actually come with interest rates as high as 30 to 45%. And increasingly, this money is being used not for assets but for lifestyle spending. Reality check: from gadgets to travel to food delivery, EMIs are now funding convenience, not creation. And that's a big problem, because debt without returns is not leverage, it's a liability. Now, the rule over here is simple. If your return is higher than your cost of borrowing, debt builds wealth. If not, it destroys it. The difference between the wealthy and everyone else is not access to credit, it's how that credit is used. Some borrow to build assets, others borrow to fund lifestyles. Compared to global economies, India's debt levels are still moderate, which means there is room to grow, but also a clear risk if borrowing continues to be consumption-led. So the real issue is not debt itself, but the quality of that debt that we are talking about. Because in the end, debt doesn't make you rich, it simply amplifies your financial decisions. So how should you use debt smartly? What kind of borrowing actually builds wealth, and what should you avoid completely? Let's bring in our expert today and break this down further with us. We're joined by Sanjay Kathuria. Sanjay, hi. Welcome to this show, and a very interesting and a very concerning topic as well, because we are looking at young Indians falling in this trap. So let's just begin with the bigger picture. Let me start with rising debt in India. An economic sign, in terms of economic maturity, or a warning sign. How do you look at it? Could you explain growth versus risk and credit expansion versus quality of borrowing scenario, if we have to understand that first?
Perfect. Thank you so much, Kavita and Itina, for inviting me here. And Albert Einstein once said that compound interest is the eighth wonder of the world. Now, we have heard this statement only till this part. Actually, everyone has heard this statement only till this part. Actually, the entire statement is compound interest is the eighth wonder of the world. If you use it, you will earn it, and if you don't, you will pay it. So I think that is the complete statement, that if you understand it, you will earn it, but if you don't understand it, you will end up paying it. And that's what sadly is happening to Indian consumers today. Let me ask you a very good question. I'll give you a deal that you give me 26,100 rupees today, only one time, 26,100 rupees today, and after 20 years, I will give you 2.9 crores. Do you think, Kavita, it's a great deal?
No.
You give me only 26,100 rupees, only one time, no SIPs, no nothing. Just one time you give me 26,100, and after 20 years, I'll multiply this money and give you 2.9 crore rupees. Obviously, sounds amazing, right?
Yeah,
Everybody will go for it.
True.
Because you are multiplying your money at the rate of 42% per annum.
Absolutely.
But the problem is, this is the deal which Indian consumer is actually offering to the credit card companies. This
Yeah.
26,100 rupees is the average credit card debt of India today. And there are approximately 12 crore credit cards which have been issued. So you can multiply this number and see what this actual number comes out to. It's humongous. And we are ending up paying almost 42% per annum. That's 3.5% per month for this particular debt, and we don't even know it. We end up paying it, and at the end of the day we end up in this debt spiral, just on and on and on. We are not able to get out of it. And that is the biggest issue I feel today, is that people are not able to understand that they are ending up paying 42%. No investment in this world can guarantee you 42%. FDs are 5-6%. Mutual funds can give you 10 to 12, 13, 15% at best. That's it. Real estate can give you, let's say, 15 to 18%, but over longer horizon. But 42% per annum,
So
nobody can give you.
So Sanjay, what exactly is happening? Because see, RBI specifically has flagged rising unsecured loans, credit cards, personal loans, the one that you just mentioned. Are we underestimating the risk of the kind of this borrowing that we are looking at? High interest, vulnerability among younger borrowers, especially, that is the problem area. Are we really underestimating this? What is the story?
So there was a survey done of 5,700 respondents that why are they borrowing? What is the purpose of their borrowing?
Right.
And 27% of people said they are borrowing for a vacation. Now, if you put this concept out to your parents that somebody is borrowing for a vacation, I think they'll go mad, because they've never understood this, equation that you can consume using debt. And this all has happened after 2020. And, till some time back, you could compare yourself to the Sharma ji ka ladka next door. But today you can compare yourself to anyone on Instagram, and you will always see some people having great lives. They're traveling everywhere. They're making reels, so on and so forth. And you feel that I am feeling left out, the fear of missing out. And then the concept of you only live once. So 27% of the respondents said that they are taking loan for traveling, vacationing. Second category was 24% home improvements. So people want to improve their homes, and for that they are borrowing. Third is credit card repayments. Just imagine, to repay a 42% loan, they are taking further loan. They don't have income to repay those loans. Then there are medical expenses, education, wedding. So all these are the expenses for which today personal loan is being used. And it is highly, highly concerning, because at the end of the day, debt is a drag. Debt actually drags your income. It doesn't allow you financial freedom. It is, it's like a big rock on your back. You have to carry it for as long as possible, right? So at the end of the day, today, the loans status is so bad that people are actually fueling their consumption by their unearned income. They're depending on their future income to satisfy their present needs. That's very concerning.
Right. Which is why the concept of good versus bad debt is very important for people to understand, because over here, not all debt is bad, Sanjay. Realistically, most Indians use debt to build assets, but over here, we are just finding it too consumption-led, which is the problem. So let's just highlight the shift towards consumption loan. Maybe that's where the story also lies, and how can we actually twist the story? You are allowed to live a lifestyle that you want to live. There's no doubt about it, unless and until you don't hamper your financial trajectory or your portfolio trajectory. But at the same time, use it in the right way. How can we do that?
So great question. See, when we talk about big business houses, we'll talk about Ambani's, Tata's, Adani's, and we look at their balance sheets. Their balance sheets have loans of 2 lakh crores, 3 lakh crores, 5 lakh crores, And for an individual, if he takes a loan of 5 lakh rupees, he's under stress. But if we look at these guys with so much loan, they are not under stress, right? So the rule of taking a loan is that first you have to plan your loan. And any loan which you take has to be backed by 3 things, 3 very important things, which even businesses look at and individuals should also look at. Businesses are smart, they understand this thing, and that is why they are well prepared to service even a 2 lakh crore debt. But individuals, they are not planning around debt, and that is why they are not even able to service a 2 to 5 lakh rupees loan. The first thing which we have to look at is, does my income have the capacity to repay this loan? Okay, does my income have the capacity to repay this loan? In financial terms, it's called the debt service coverage ratio. Let me make it very simple. Let's say my income is 1 lakh rupees a month and my EMI is 30,000 rupees a month. So in that case, I can say I'm reasonably safe. My income can take care of my debt or my EMI three times. So in a month, I can pay three times my actual liability, which is a good number. Now, there are people who are at 1 lakh income, but their EMI is in the range of 70 to 80,000. Now, how is this person able to survive? With a 1 lakh rupee income, how can he repay 70 to 80,000 rupees per month? So the first rule is that your income should have the capacity to repay your loan consistently. Now, what is the good ratio? So let me talk about good debt and bad debt. Like a cigarette box has this very bad photograph that, that you don't want to smoke after that. If you see that photograph, it's very bad because smoking kills. That's what a cigarette box reads. Similarly, I think on a credit card also, there should be a line, which is debt is addictive and interest kills. So I think till the time we don't, force it in the minds of people, people will be overspending and they'll not focus on their earning. They will only focus on spending. So what we have to look at here is if you are taking debt for consumption, it is called bad debt. Okay. But is it so that we should not consume at all? I think that's not the right case. We should formulate a rule. And the rule is the 15% rule. Whatever is my income, post-tax income, only 15%, 15% of that can be EMI towards consumption-led expenses. What are consumption-led expenses? I want to buy an iPhone. I want to go on a vacation using debt. I want to buy a car. I want to buy any depreciable asset. Okay. Or I want to buy an experience. That should not exceed 15% of my monthly take-home income. Now, just imagine you're at a take-home income of 1 lakh rupees and you're spending 15,000 rupees as an EMI towards all these consumption-led expenses. You're very, very comfortable. Now, suddenly you have reached your peak of 15,000 rupees. Now you can consume only when one of the two events happens. One is that some older loan just gets off. You have repaid that loan and you have some new space created in that 15,000 rupee amount. Or the second is that your income rises from 1 lakh to 2 lakh. So when your income rises from 1 lakh to 2 lakh, your budget goes from 15,000 rupees to 30,000 rupees a month on consumption-led EMIs. So both the cases are very healthy for you. In one of the cases, you have repaid one of your debts and you have created space to take another debt. In second case, you have increased your income to consume further. Both the cases are very good. So when you follow a rule-based mechanism, it becomes very, very easy to control your finances and to control yourself. It's like a toll gate, and I think life also needs to have a toll gate that if I don't achieve this, I will not be able to, do this. So if I'm able to achieve a 15% ratio, I will consume. No problem at all. I'll buy the new iPhone. I'll buy the new sneakers. I will go for a vacation. I will do my home renovation. I'll do an expensive marriage. All that is great. But stay within the limits of that 15% ratio. I think you'll be very, very comfortable.
So this is something that, one has to do like a lifestyle management and think about it. No one is stopping you living a better life. But having said that, let's take the conversation towards making people wealthy by using the right kind of debt. This was about the consumption loans or consumption bad debt that we were talking about. But how do we become wealthy? How do we, direct that debt in the right direction?
So I think we have to look at what we are creating from the money. So as simple as this, that we take up a home loan, right? So the house is worth 1 crore rupees. You put down 20 lakh rupees, you take a 80 lakh rupee loan. And you know that over, let's say, 10 odd years, the apartment price will double. It will have a negative cycle, it will have a positive cycle, but you will double your apartment prices, your rentals will increase. So in this case, I would still call it a good debt because you're using debt to actually finance something which will appreciate in value. So that's point number one. Second way to actually, look at debt like a hurdle race. Let's say there's a 100-meter hurdle race and there's a hurdle at every 30 meters. So till the point you don't hit the hurdle, your knee doesn't hit the hurdle, you will clear the hurdle race and you will win. The moment you hit your knee to a hurdle, That's when the problem starts. And that's how debt operates. Every month you have to pay interest or an EMI. So your cash flow, your monthly cash flow has to be enough and has to be predictable so that you can repay your debt on timely basis. Because once you hit this hurdle, after that, running at the same speed becomes very, very difficult. So all the businesses who leverage to become rich, all the billionaires who take leverage to become rich are only focusing on one thing. I am taking money at, let's say, 8% per annum. How can I find an opportunity, or how can I create an opportunity, be it a business, be it a startup, be it a freelancing gig, or be it creating a website, be it a D2C business, anything. How can I create something which can give me more than 8% returns consistently? And that's where you need to really rack your brain, that what should I do which creates more than 8% in terms of returns for me. And obviously, as the number of years pass by, and if I'm able to create better returns, I will create more money for myself. And that's how the power of leverage works. If you look at any business today, they wouldn't have been a successful business without debt. Tell me, could Reliance build a Jamnagar refinery without debt? Could Reliance build a Jio without debt? Could Adani's build a port without debt? Could Tata's build their huge steel factories without debt? Could Jindal make those electric plants or electricity plants without debt? I think all of that was not possible. But they were great opportunity seekers. They took that opportunity, they executed it well, they took the debt, they were financially very, very disciplined. And let me tell you, great organizations and people who can handle debt very well are highly financially disciplined. They budget every day of their life.
Important
They
aspect,
know
yeah. Yeah.
they know where to spend their money. They are
Totally.
tracking their expenses on a
Yeah.
very, very regular basis.
That is important. Financial discipline, I think that's the most integral recipe for your financial life. And you rightly mentioned, if your returns are higher than your borrowing cost, taking debt, it actually works. It converts into making you a wealthy person. Otherwise, it totally backfires. But one cannot miss the EMI trap. That is also true. Is there any way we can miss the EMI trap, even for using debt to create wealth?
See, EMI trap happens when you're not sure of your cash flows and when you have not done your mathematics right. Okay. When you are creating something, or when you want to invest in something, you have to look at how will this investment fare for me? Will it give me immediate cash flows, or will it take a year to give me cash flows? If it is going to take a year for me to get cash flows out of this real estate or investment, then I need to have the cushion for a year so that I can pay it myself. Do I have that cushion? Now, let me give you this example. A lot of people I remember in 2011, 12, they started buying houses in NCR region, left, right, and center. Everybody was buying 2 houses, 3 houses. Why? Because they were getting very, very easy debt. So they started buying. And they thought that the moment they get those houses, they will put it on rent, or they will flip it or sell it, and they will make money out of it. Now, what happened was they didn't factor for the fact that some of these developers made default. So what they did was they over leveraged. They took one property, they took two properties, they took third property, they took payment plans. And finally, what happened? A lot of these developers ended up defaulting. Now, those guys who invested in these properties are still staying on rent, paying their rent, and still paying EMIs for 2 or 3 houses. And still they have not got those assets to them. Now, if you are doing something like this in greed, that, my God, oh my God, let me invest today, the property prices will double every 3 years or 4 years. You don't have requisite cash flow. You're not planning your entry and exit. You're not planning when will you require the money to pay to the developer. What is the next cash flow cycle? I think you will be in a very, very big mess. So whenever you're taking an investment decision, be very, very fearful at the time of taking the investment decision. Do your mathematics properly. See whether you will be able to afford it or not afford it. What will happen in the worst case? I think Indians, we are not trained by mind to factor on worst case. We always feel we'll be jinxed if we talk about worst case. Great organizations, great people always talk about inversion thinking. And that's what Charlie Munger always used to preach. He used to say that if somebody asks me, how can I be successful? I will not talk about how can I be successful. He will say that what are the events which can make me a failure? I just need to get rid of those events. So once you start thinking on this inversion theory and you start working on, before making an investment, you're very focused on what your cash flow is going to look like. Will you be in an over risk of leverage? Will you be able to repay your debt? I think once you do that mathematics, a lot of your problem will be knocked off, and you will not fall in the CMI trap.
So the message is very clear. Debt itself is not the problem, it's how you use it. Used wisely, it can build assets, and used poorly, it can destroy financial stability. Sanjay Kathuria, thank you so much for joining us and sharing those insights. And to our viewers, as markets remain volatile and